So I sent this video because you asked us about your estimated tax payments. Now, since we use this video for multiple clients, I can't explain your specific situation, but this video does typically answer almost all questions clients have about estimated tax payments, and a lot of times it answers all of them. So please watch the video, and if you still have questions, just let me know so that I can clear them up and help you better understand your specific situation. I'll briefly cover why estimated tax payments exist, who needs to make them, when they're due, how we calculated them, and options to simplify or avoid them. Now, the tax code requires us to pay in our federal income taxes as we go throughout the course of the year, rather than waiting until the tax return due date. For W-2 employees, this happens automatically. Your employer withholds a portion of each paycheck, and it sends that to the IRS on your behalf. But if you receive income that is not subject to withholding, like self-employment earnings, rental income, or investment gains, you might need to send in estimated tax payments yourself. You're required to make quarterly payments if, when you file your tax return, you owe more than $1,000 in tax after subtracting any withholding. If you are fully self-employed, you almost always need to pay quarterly estimated tax payments. If you have a W-2 job plus other income, if your withholding doesn't cover all of your tax, you will need to make estimated tax payments to cover that gap. Estimated payments are due 4 times each year: April 15th, June 15th, September 15th, and January 15th of the following year. If you miss these deadlines or underpay the amount that is due at each quarter, that can trigger interest and penalties. Now, we don't actually know what you're going to owe this coming tax year. Because we don't know your exact income for the year in advance, the tax code offers a few safe harbor rules for avoiding penalties and interest. The one that we've used is the 100%, 110% rule. If you pay at least what you owed last year, 100% of that, you won't have to pay any penalties and interest. If your income goes up, you still might owe additional taxes at tax time, but because you hit that safe harbor, you won't owe penalties and interest on any underwithholding. This safe harbor increases from 100% to 110% if your adjusted gross income is above $150,000 in the prior year. So we have based your current year estimated tax payments on your finalized prior year tax return that we just completed in order to hit this safe harbor. If you have W-2 income, you can adjust your Form W-4 so that your employer withholds more tax from each pay period to cover your other income. This can eliminate your need to make estimated tax payments even if you have other income that doesn't have withholding on it. As long as the tax gets paid, the IRS doesn't really care where the payments come from. So taxes owed on a side hustle can be covered with extra withholding from your W-2 day job, and you can avoid needing to remember to make quarterly estimated tax payments. So what you need to do is review the payment schedule that we sent and mark your calendar for April 15th, June 15th, September 15th, and January 15th of next year. Decide how you're going to pay these. I recommend using direct pay through the IRS website at irs.gov/payments, or you can use the vouchers that were provided and mail in your estimated payments. Contact me if you have any questions about your specific situation, especially if you expect major changes this coming year. Because your estimates are based on the prior year, we probably need to make some adjustments if the current year is going to be significantly different from last year. Now, as a real quick recap, everyone must pay taxes as they go throughout the year. For the majority of people, this happens through their paycheck. But if you don't have a W-2 job, or if you have other income on top of your W-2 job, you likely need to make estimated tax payments on a quarterly basis. If you do have a W-2 job, you can avoid these by increasing W-2 income tax withholding instead. Otherwise, you do need to make the quarterly payments to avoid interest and penalties at tax time. The estimates are based on the prior year information. They are estimates, and if your income increases, you're likely still going to owe more tax at tax time, but at least we've avoided penalties and interest by using this safe harbor method. Lastly, if you expect significant changes in the current year, these estimates should be updated based on a projection of the current year realities. Again, if you have any questions, please let me know.